There is a number sitting in your retirement account right now. Maybe it's $40,000. Maybe it's $400,000. Maybe. You've spent years building it, contributing every paycheck, watching it slowly grow, telling yourself that at least you're doing the responsible thing. And that number is real. But what's also real is that somewhere on Wall Street, there are people who have figured out how to use that number, your number, to make themselves richer. And the worst part, the mechanism that allows them to do it, was sold to you as the smartest financial decision you could ever make. This is the story of how passive investing, the single greatest financial innovation of the last 50 years, quietly became the most powerful extraction machine in the history of American finance. And nobody's talking about it, not because it's complicated, but because the people who benefit from it also happen to own the media, companies that would cover it. So let's talk about it, to understand how your 401k became Wall Street's ATM. You first need to understand what a 401k actually is. Not the brochure version, the real version. A 401k is a tax-advantaged retirement account that your employer offers. You contribute a percentage of your paycheck before taxes. Your employer sometimes matches a portion, and that money goes into a menu of investment options that your employer has, pre-selected for you. You don't pick the menu. You pick from the menu. That distinction is going to matter a lot in about 3 minutes now. Most people, when they open a 401k, do what their HR department tells them to do. They pick a target date fund or a broad index fund. They set their contribution percentage, and they forget about it. And that's not stupidity. That's the design. The entire system was built to make you a passive participant. Set it and forget it. Let the market do the work. Trust the process. And for most of the last 4 decades, the process worked. The stock market went up. Retirement accounts grew. The pitch delivered. And that success story is what made passive investing the dominant force in markets today. Here's what that dominance actually looks like in numbers. In 2010, passive funds held about 20% of all U.S. stock fund assets. By 2024, that number had crossed 63%. More than $13 trillion now sits in passive index funds. Money that doesn't analyze companies, doesn't read earnings reports, doesn't have an opinion on whether Apple deserves its valuation. It just follows the index automatically, every single paycheck cycle. And this is where the story starts to get interesting. Because when you have $13 trillion of money that buys automatically, you've created something extraordinary. You've created guaranteed demand. And guaranteed demand is the most valuable thing in financial markets. More valuable than a great product. More valuable than strong earnings. More valuable than a competent management team. If you can get your stock into an index, the money flows in automatically. No pitch required. No roadshow. No convincing. Just inclusion, and then the capital follows on autopilot. And the people who run Wall Street figured this out a long time ago. Here's how the extraction actually works. Because it runs in 3 layers and most people only see the surface. Layer 1. The index inclusion game. The S&P 500 and the NASDAQ 100 are not neutral lists. They are curated by committees. And the rules for getting onto those lists have changed dramatically over the last decade. When a company gets added to the S&P 500, every passive fund tracking that index is legally required to buy it. There's no discretion. There's no due diligence. The index says buy, the fund buys. And with $13 trillion tracking the S&P alone, even a small allocation to a new entrant means billions of dollars of mandatory inflows. So what's the game? Get into the index. Get the automatic buying. Let the passive flood push your stock price higher. And then, quietly, the insiders who own the stock at a low basis sell into that manufactured demand. The buyers, passive funds. Your 401k, show up first and buy at elevated prices. The sellers, insiders. Early investors, venture funds. Show up later and exit into the rally. The mechanism transfers wealth from passive holders to early stakeholders. Every single time a new company enters an index. And it has been happening for years, but it just got turbocharged. Layer 2. The rule changes nobody covered. On May 1st of this year, NASDAQ adopted something called the Fast Entry Rule. And if you missed it, don't feel bad. Traditional financial media buried it. Under the old rules, a newly listed company had to wait at least 3 months before it could be added to the NASDAQ 100 index. That waiting period existed for a reason. It gave the market time to actually price the 3 months of the market asking hard questions. The new fast entry rule cut that window from 3 months of price discovery compressed into 3 weeks, which means the window where the market can actually figure out what a company is worth before your 401k is forced to buy it just shrank by 80%. But that's not even the most important change. There used to be a minimum free float requirement. A company needed at least 10% of its shares actually available for public trading before it could join the index. That rule existed to prevent manipulation. A tiny float means a small number of sellers can move the price dramatically, creating the illusion of value that doesn't actually exist. The new rules eliminated the minimum entirely. Passive investing is not a scam. Index funds are genuinely good products. Low fees, broad diversification, long-term compounding, all of that is real. All of that works. The research supporting passive investing over active, stock picking for the average retail investors overwhelming and decades deep. But there is a difference between a good product and a system that has no problems. And the system built around that good product has developed structural vulnerabilities that most retirement savers have never been told about. Because here's what the brochure never said. The same mechanism that makes passive investing convenient and effortless for you. The automatic buying, the no decision required simplicity, is the exact same mechanism that makes you a guaranteed beer for anyone who can engineer their way into an index. You handed someone else the wheel and told them to drive responsibly. And for a long time, they did. But the car got bigger and faster. And a lot more people got into the passenger seat. And now the people engineering the on-ramps are the same people who own the road. And right now, this system is being stress tested in real time because the largest initial public offering in human history is reportedly coming within weeks. A company that lost nearly $5 billion last year on $18.5 billion in revenue. A company with 3 businesses stacked on top of each other, one of which burns roughly $1 billion a month. A company targeting a free float of 4 to 5%, which under the old NASDAQ rules would have been an automatic disqualification. Under the new rules, it qualifies. Under the new rules, it gets fast-tracked into the index inside 15 trading days. Under the new rules, that 4% float gets weighted as if it were 12%. Under the new rules, your 401k becomes a beer, automatically, without your input, without your vote, without anyone asking you, portfolio manager. George Noble put it better than I ever could. Your 401k is the exit liquidity, and that's the game. Insiders own the stock at a low-cost basis. The company goes public. Passive funds are engineered into buying it at peak valuation. The index inclusion triggers automatic demand. The insiders sell into that demand over time. And somewhere in the background, your retirement account absorbed The shares at the top. So what do you actually do with this information? First, understand what you own. Lock into your 401k today. Look at your index fund holdings. Look at what percentage of the fund is concentrated in the top 10 names. If the top 10 names make up 30 to 40% of your index fund, you are not as diversified as you think you are. Second, understand that fees are not the only cost of passive investing. The hidden cost is the structural risk of being a mandatory bear in a system that is actively being gamed by the people who understand it best. Third, understand that none of this means you should stop contributing to your 401k. The tax advantage alone makes it one of the best financial tools available to the average American. But eyes open is always better than eyes closed, especially when someone else's hands are on the wheel. Because the pitch for passive investing was always this: take yourself out of the equation. Let the market do the work. Stop trying to beat the system. And that pitch is mostly right. But what nobody added at the end of that pitch is the part that changes the whole picture. When everyone takes themselves out of the equation at the same time, the equation changes. And right now, $13 trillion of retirement savings are sitting inside a structure that was designed for a different era, a different market, and a very different set of rules. The rules just changed, and the people who changed them are not the ones whose retirement is on the line. Yours is. So if you're tired of traditional financial media handing you the simplified version of what's actually happening to your money, hit subscribe. Because this channel exists for one reason: to cover the stuff they won't, because the real risks to your financial future aren't the loud ones. Those are usually priced in. The real risks are the ones hiding inside the system you already trust, and you just found one.